Get Rich Education is brought to you by Mid-South Homebuyers, top-notch turnkey property in Memphis, Tennessee.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 51. I'm your host, Keith Weinhold, and I'm back to help make you more successful than me, faster than me. We're going to look at real estate investing from the other side of the table today. How would you like to be the bank? Yeah, being well-versed in investing means being able to evaluate investments objectively, to look at investments through different lenses and at different angles. And there are just so many investing vehicles that you can use with real estate. And today's angle of mortgage note investing is one that you probably haven't considered previously. Now, during certain periods of a market cycle, one investment might make more sense than another. That's why now, late 2015 and into 2016, mortgage note investing could make a lot of sense for you. Cap rates on income property just continue to fall as people are willing to pay more money for a property that produces the same amount of income that it did a few years ago. Okay, and since a cap rate, again, that is a property's income production divided by its sale price, and now investors are paying higher sale prices for that same amount of income, well, that results in that falling cap rate, which is less profitable for you. That's why I'm highly selective in bringing you a Mid-South Homebuyers in Memphis or a Maverick Investor Group where they hand select the best U.S. markets, because otherwise a lot of the best deals are just drying up as cap rates get squeezed and driven down in a lot of markets. Now, an alternative is where you can be the bank. Okay, basically, you can be the lender rather than the borrower, still get a good rate of return, and be hedged in the event of a market dip. So rather than looking at real estate from the equity side like we usually do, you're looking at it 180 degrees differently in a sense today, where we're going to go ahead and look at the debt side. So you're the one making the loan to someone else. Now, why would you want to do that? Well, you're going to meet my best known resource for explaining why you might want to be a mortgage note investor, what mortgage notes are, and how my guest can help you get started and do it right now. As a real estate developer, investor, syndicator, and broker, David Campbell has been a principal or key advisor to over $800 million worth of real estate transactions, and he's been all over the spectrum. That includes apartments, office, retail, winery, hospitality, condo conversion, and production home building. David has served on the advisory board for many companies and government agencies. His current and past consulting clients include real estate development companies and hedge funds with projects in excess of $10 billion. David Campbell has been interviewed and featured in numerous publications. He's a frequent keynote speaker at real estate investing clubs and investment seminars. You might have seen David if you've been to some of those, because David's in high demand as a guest speaker at numerous investor clubs, radio shows, and universities. And David is a former high school band director turned mega successful real estate investor. I'm really happy to have him today. Welcome to Get Rich Education, David Campbell.
Keith, I'm so excited to meet myself. That was such a great introduction.
Hope you like yourself. So listeners, David, he's just been a really good resource for me since I've been introduced to him because he has such well-rounded experience in so many aspects of real estate. About 2.5 years ago, I was going through a big transaction, a 1031 exchange, and I just gave David a call just kind of as a second opinion to see what he thought of the deal. So he's just been such a good resource. David, what have you been up to lately?
Well, Keith, I've been really paying attention to market cycles. So as an investor who's been doing this a while, we had a great run up in the market, in the late 90s, early 2000s, and then the late 2000s real estate crash really negatively impacted my personal life and my financial life quite considerably. And having gone through a market boom and a bust, I am hypersensitive to trying to steer clear of the next market correction. So very much trying to keep my finger on the heart of the market cycle and try to make smart real estate and investing decisions through this next market cycle.
Yeah, see, it's really easy, listeners, to be sunny and optimistic when real estate's been rising year after year like it has been. It could run ahead for a while, but a while is going to come to an end at some point. And with David's experience, he's been through market cycles, so he knows when to act during when one might sense a dip. So, David, one thing I know that you've been doing is maybe not doing as many equity investments where you're putting a down payment on a turnkey-like property. So instead of being on the equity side and investing from the equity side, you found a way to invest from the debt side. Can you tell us a little bit about that?
Absolutely. So although I love owning real estate is primarily going to help you make money in an upwardly trending or sideways trending market. But in a downwardly trending market, which we're not there yet, but I just want to be in position to prepare myself from a potential market correction. I want to be the lender. I want to be the debt holder on that property, with the borrower putting a significant down payment on that property, so that if we do have a market price correction, I've got that borrower's down payment as protective equity against my investment. And so, for example, here we are in 2015, where it's a seller's market in many markets, and it's harder to get attractive cap rates than it used to. So what I'm doing is using my capital and the capital of our investor clients to buy mortgage note positions, or to use our money to be the bank. So we can actually lend our money, typically maximum of 75% loan to value on a fully amortizing mortgage position, which means if we've got a couple more years of an up market followed by a market correction like we had in 2009, 2010, by the time that market correction comes down, our loans will have amortized considerably, and I think we'll be well positioned to weather another down market. It's possible that if we are loaning well, we're making a very strong yield. 10% yield is pretty common for us in our mortgage positions. And if we lend well, then we'll make our 10% yield for a number of years. And if we wind up owning the property through foreclosure, which is unlikely, most mortgage notes do perform. But if we do wind up owning that property, we're owning it for 50, 60, 70 cents on the dollar relative to today's market position. And so I think that's smart from an income perspective, from a yield perspective, and a risk mitigation perspective. And that's why you see a real estate investor like myself singing the song about first position mortgage notes, which is kind of boring. It's kind of simple. It's like watching the grass grow, but I think it's the place to be in this market.
Yeah, and it's probably pretty stable. Now, before we're done here, David and I are going to talk about how you, the listener, can get in and be a lender rather than being the borrower, and how you can benefit from that. But first of all, just to clarify, so we're talking about what this is called here, David. We're talking about mortgage note investing, aka seller financing, or are there some other names for this vehicle?
There sure are. Yeah, there's a lot of names that kind of are synonymous. There's slight technical differences, but some good names would be hard money lending, private lending, deed of trust investing, seller financing. One of the technical differences is there is a note, which is the promise to pay. Anyone can make a promise, but I, as a smart investor, want to know, am I profitable if I get repaid? And that's the interest rate. Is the interest rate attractive enough to draw me in to make that loan? Number two, am I profitable if I don't get repaid? And I really genuinely want all of my borrowers to succeed. But if they don't succeed, I need to be prudent enough and shrewd enough to make sure that even if my borrower doesn't succeed, that I'm going to have the property itself be sufficient collateral to repay me and to be profitable for me as a lender. So that security instrument is sometimes called a mortgage, sometimes it's called a deed of trust. Each state sets their policy on whether they're a deed of trust state, which is the security instrument to back up that loan, to connect the promissory note, to put a lien on a piece of real property. That's what the deed of trust does. A mortgage effectively does the same thing as a deed of trust, but the difference is a mortgage, to foreclose, you have to file a lawsuit. And a deed of trust, you do not. A deed of trust, you give proper notice to the borrower and to the whole world in general that the borrower has defaulted. And then the trustee in that deed of trust goes to the courthouse steps and they can sell that property without ever initiating a lawsuit. And that brings me to my first point about the types of mortgage notes that I like. And that's actually, they're not mortgages at all. They're deeds of trust. We really like owning notes that are secured by deeds of trust because the deeds of trust are cheaper, faster, and easier to foreclose upon.
Okay, and just to clarify, we're talking about if you, listener, as the lender, need to go ahead and foreclose on the person that you lent that money to because they're no longer making those monthly interest payments to you for the loan that you just made to them. You have the right to go and foreclose on the property, which is your collateral in the deal. Did I summarize that well, David?
That's right. Yeah. I think statistically, somewhere around 98% of mortgages in America are paid as agreed, but there's 2% of the time where the borrower doesn't pay. And in that particular situation, you want to make sure that you've got good recourse, which is the real estate. And that's the whole magic behind mortgage note investing, is you're profitable if you're repaid, which is 98% of the time statistically, and 2% of the time when you're not repaid, the property itself, the equity in the property, is the vehicle that repays your loan.
Right. Okay. So you would get a lump sum payment in that case, if you want to call it that, after you take the equity that the borrower has in the property minus any of your costs to go ahead and foreclose on it. That's your profit in one lump sum.
That's right. Yeah. So on a $100,000 property, a prudent lender is going to lend a maximum of $75,000 against that property. And if that property goes into foreclosure, minus the foreclosure costs and the cost of resale, maybe you're going to get back, $80,000 to maybe $95,000 on that particular sale. But because you only loaned $75,000, you come out with all of your money plus a potential profit.
Right, plus any of those payments that you might have been getting each month in the meantime that they were making before they defaulted.
That's exactly right.
So I guess that would lead one to think, you talked about 75% loan to value loans. So that would mean me, if I'm coming as a lender to somebody, I want to have them put a 25% down payment on the property. I bring $75K that they borrow. Now, does that necessarily mean that I have to come up with $75K to do a 75% loan to value on this $100,000 home, or do I not need to come in with that much?
Yeah. So as a first position lender, you're lending usually unleveraged. So all of the money that you use to make the loan is cash. Some of our clients are able to what I call arbitrage or positively arbitrage, which means maybe they own a property currently. They can refinance the money out of that property at a low interest rate, like 4.5%, 5%. And then they can go lend that money in first position, secured by a property at a maximum 75% loan to value, and they might get a 10% interest rate. So in that particular case, they didn't invest cash, they just invest proceeds of loan, but they had to have the equity to start with, right? But they are borrowing at 5 and then lending at 10, and they're making a pure 5% profit arbitrage spread from borrowing and then relending at a profit.
I love that you brought up the word arbitrage. That's one of my favorite words in the investing world. So you're talking about if one does a cash out refinance of their home where they can pull $75K out of it, pay a 4.5% interest rate on that, which is also tax deductible, go ahead and lend it out at 10%. And the difference they make is the spread, the 10% minus the 4.5% that they borrowed out. And that 5.5% is their profit.
That's exactly right. And the arbitrage formula is something that very few people teach. And so I'm excited to hear and excited for your listeners that you teach that concept so well. When we're talking about hassle-free cash flow investing, one of the fundamental parts of being a hassle-free cash flow real estate investor is that the cap rate, which is the property's net operating income divided by the property value, that cap rate must exceed the interest rate. And so if you've got a 6 cap property and a 5% financing, well, then you've done the formula right. Your cap rate is 6, which is higher than your interest rate of 5. Many investors get that formula upside down, where they go and buy a 4 cap property with 5% debt, and they've got negative arbitrage. When you have positive arbitrage, the more money you borrow, the higher your yield goes. You can borrow at 5 and invest at 6. Well, Keith, how much money do you want to borrow at 5 to invest at 6?
Everything I can.
Yeah, but we flip that. How much do you want to borrow at 5 to invest at 4? The answer is none.
None.
And so the challenge in today's market is many investors have a fixed cost of financing. For investor financing today, 30-year fixed loans are around 5%, maybe plus or minus a little bit. And in many markets across the country, particularly high-cost areas, you can't find properties that are producing a cap rate about 1% higher than the prevailing interest rate. So if you borrowed money at 5 and you tried to reinvest it in your local market, many local markets aren't producing a cap rate of 6 or better. So those investors are choosing, they've got to go into other states, like Texas is my favorite state, or perhaps the Midwest, where those cap rates are a little bit higher. Or I think an even larger spread between the borrow and the cap is private lending. Because when you borrowed at 5 and you go invest it into a property at 7, well, that's a good spread, right? But if you could borrow it at 5 and go buy a mortgage note at 10, now that's an even wider spread. And in a buyer's market, like we saw in 2008, maybe 2010, 11, we were seeing those big cap rates. So you could borrow the money at 5, and it wasn't hard to go find a piece of property that, produced an 8, 9 cap rate, and you could get those big spreads. Today's different. It's a seller's market. And so those arbitrage spreads are smaller in real property, which is why I'm focused on getting those arbitrage spreads in the debt market, being a lender.
Now, I'm just still trying to come up with our compelling why as to why one would want to go ahead and do this. In the last 10 years or so, we know about something called peer-to-peer lending that's become quite popular in some circles. Companies like LendingTree and Prosper are already set up such that I can go be a lender to someone else and get preferred interest rates. So I guess, how does mortgage note investing work out better for the lender than like a peer-to-peer lending company would, David?
That's an excellent question. And the primary answer is, when you're doing peer-to-peer lending, you're profitable if you are repaid. And if you're not repaid, you have a loss. There's no secondary recourse. You just tell the borrower, pay me again, or I'm going to say, pay me. And if they don't pay you, you say, well, pay me, or I'll say, pay me again. And that isn't really setting you up for success. When you are mortgage investing, if they pay you, you're happy. And if they don't pay you, you get to own the property.
Right.
And so that is a huge apples to oranges comparison. I can see why people do the Prosper program, but to me, it's extremely high risk relative to mortgage investing, which I think is extremely low risk. They're very different risk profiles.
Yeah, so I think in short, you're telling me the difference between mortgage note investing and peer-to-peer lending is collateral. And you might be just as happy not to be repaid by the borrower as you are to be repaid by the borrower.
That's right. Some investor lenders call that loan to own, that they're making a loan hoping not to get repaid back.
Right. Here we are in late 2015, and, it sure seems to me, and, part of the reason I wanted to have you on the show today, David, is because in the climate that we're in today, there are a lot of economic forces that make mortgage note investing so that it makes more sense than it would at other periods of time. Part of that is that conventional financing is still difficult. It's still difficult to get a loan. So they might have to go to a private borrower like you or a listener to go ahead and get a loan, because they just cannot clear those tall hurdles to getting a conventional loan anymore. So do you have a few comments on that? Are there some other reasons why you find late 2015 to be a great time to be a mortgage note investor?
I think one of the best reasons to be a mortgage note investor in 2015 is the a lot of investors have equity. They bought at market lows, and congratulations, the market has done the thing that they wanted it to do, which is they bought low and then the prices are inflated. And for many investors, if they don't cash out and reposition their equity into a safety first position, they're setting themselves up to leave that equity exposed to the next downward market cycle. And for people who have not been investing a long time, that they've been buying in 2010, 2011, I encourage them not to be naive and think that the markets will always go up. The very thing that gave this market equity to them is price fluctuations. And they were smart to buy low. And the important part of that formula is sell high. And so when you sell high, what do you do with your money, right? If the market's high, you're going to go buy high. That doesn't make sense. So you sell high and you've got to go do something with that money until the market corrects. And for me, when equities are overpriced, you buy bonds, right? That's how the stock market works. You know, people go back and forth between stocks and bonds. And when stocks are low, people sell bonds and buy stocks. And when stocks are high, people sell stocks and they buy bonds. And in the real estate market, the equity or the stocks is the real property, right? When prices are low and the ratios between rent and purchase price is very favorable to investors, then you buy. And when that ratio breaks down and the prices are high, and you ask yourself this magic question, would I buy the property that I own? Would I purchase the property that I own at today's current prices?
Right.
And if the answer is yes, then keep holding it. You know you got a winner. And if the answer is no, what fool would pay this price for this property? Then you know you got to sell. Sell the property, but then you get your cash. And you can't just sit on cash. You got to get that cash doing something. To me, the answer is you turn the cash into first position. I'm going to say that again. First position deeds of trust, where if the borrower pays you, you're happy. If they don't pay you, you're getting ownership of a piece of property for pennies on the dollar. And you've protected your equity. You moved it out of a high inflated equity into another equity, right? Or into a bond, a safety first position. And that borrower's down payment is the thing that's protecting you from market fluctuations.
I really like the way that you put that. When one is considering how much equity they have in a property, they need to ask themselves a question, would I buy this property today at this price or not? And if the answer is not, it usually makes a lot of sense to remove that equity from the property and go ahead and put it into either another property or a mortgage note like we're talking about right now, because there's such a huge misconception out there, and I've talked about this on my show so often, David, that somehow the presence of equity in a property helps with its appreciation rate. It has absolutely nothing to do with the appreciation rate. And I really like the way you put it about would you buy it again? So you're listening to Get Rich Education. My guest is hassle-free Cashflow Investing's David Campbell. More when we come back. I'm your host, Keith Weinhold. Cashflow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Hey everybody, this is Matt Bowles from Maverick Investor Group. You're listening to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education with our feature guest, hassle-free Cashflow Investing.com's David Campbell. So, yeah, David, we were talking about equity and how a lot of people have a misconception that the presence of it in a property helps with its appreciation. But effectively, you can turn that equity into cash flow.
That's right. I do so many one-on-one consultations with investors who've got a very strong balance sheet. They're equity rich, and yet they still feel stuck in their day job because they don't know how to transition from a strong equity balance sheet, a very strong net worth, into a very strong cash flow position. And I think mortgage notes are an excellent transition for when an investor has planted the seeds of wealth and those seeds matured into a very strong balance sheet, a large equity, because real estate, ownership of real estate is great for building equity. And once you've got that equity, a lot of people don't know that they could trade that equity for income through mortgage notes. And there's a lot of strategies for doing that. And when they do transition their equity into cash flow, a magic formula that I like to use is I'll ask a client in a one-on-one consultation, is your net worth, your investable net worth, at least 100 times your monthly expenses? And if they are, then they are what I call a tipping point. They've reached the tipping point where growing equity is probably less important for them than transitioning or converting that equity to cash flow. Because if you could say, for example, take $1 million equity, $1 million net worth, and get that into mortgage notes that are producing a cash flow of 1% per month, then they're living on it. That creates a $10,000 a month cash flow. And for that investor, that cash flow is the thing that will enable them to quit their day job or to get out of the rat race. And then for a lot of people, once they've made that tipping point and they're out of the rat race, they might use that freedom of time to go build a even more powerful real estate portfolio than they did before. So some investors who get that itch to say, well, I don't want to sell my property to buy mortgage notes. The answer is, well, would you like to trade your property for financial independence? Once you have financial independence, you can go back to doing whatever you want, including building your real estate portfolio even stronger.
Right. Begin with the end in mind. Some people don't realize either. As soon as they separate equity from a property and put it in a second property, it's still their equity. They still have the same amount of equity that they did previously, although they might just have a little corner chipped off for some transaction costs. But it's basically still their equity, and now they're producing monthly cash flow with it at the same time. Because, a dollar is not a dollar, is not a dollar. You could have two $1 bills sitting here on this table. They might look the same, but if $1 is a cash flow dollar, that is liquid. If the other dollar is an equity dollar, that's not the same. That's trapped. That's illiquid. You might not necessarily be able to get to that. Hey, speaking about trapped dollars, David, or what some people might deem as trapped, can you use dollars that you have in an IRA to go ahead and free that up for buying mortgage notes that can produce a cash flow for you?
Absolutely. Having a self-directed IRA, I think, is one of the most powerful ways for investors to buy mortgage notes. Because unlike real estate, which is a very tax-efficient asset, mortgage notes produce ordinary interest, and that interest is taxed at the ordinary income tax rate for most people, which means it's tax inefficient. However, if you use your self-directed IRA to buy a mortgage note, and then that income from the mortgage goes into your IRA and it stays tax deferred, or if it's Roth, it could be tax free. And it also brings up the point of, as a real estate investor who loves mortgage notes, it's important to balance your portfolio with the right tax efficiency. For me, I want to own 100% of my real estate holdings outside of my IRA, because there's so many tax efficiencies like depreciation on the property, the ability to get superior financing on the property outside the IRA, the ability to defer the capital gains on that growth of the property until you sell it or 1031 exchange it. And then when you die, you get a step up in basis on the equity. There's all kinds of really powerful tax reasons to own property outside of your IRA. But if you buy that same real property inside of your IRA, you lose all of those magical tax efficiencies. And that's why, for me, when I'm building my self-directed IRA, 100% of my IRA is invested in mortgage notes. and 100% of my real property is outside of my IRA. And if investors get that flipped or backwards, or they try to start buying property in their IRA, I think they're going to find that that's a very tax inefficient plan.
And now I know some of you have not heard of a self-directed IRA yet, where you can go out and choose your own custodian and invest in what some would call alternative investments. That's a whole other subject, and I'm sure David could help you out with that. I do have a self-directed IRA myself. David, I guess one would really want to know next is, how do you identify mortgage notes to buy? And, how do you know what you should avoid when you're looking to buy a mortgage note and get a nice, stable return from it?
That is an excellent question. And so there are lots of ways to find mortgage notes for sale, but most of those are reserved for people who have a significant, like multiple seven figures to go invest in mortgage paper. So you could go to a bank and say, hey, Mr. Banker, do you have mortgage notes for sale? And they'll give you a list of $10 million of mortgage notes to buy. And for the average investor, that's not a very realistic solution. And also the mortgage notes that banks have for sale are usually very low yield. They're producing a low rate of interest. For our business, we focus on mortgage notes where the borrower is strong. They've got a good income, a good debt to income ratio. The collateral is good. There's equity in that property protecting the lender's investment. But the borrower's credit is deficient in some way, which is the reason they're willing to pay a high rate of interest. Those are very common sense loans where the borrower has the ability to repay, the property has the ability to repay, but the bank won't do the loan. So the borrower is grateful to borrow the money at 8, 9, 10, 11% interest because no one else will do the loan but a private investor. So the hard way to go find mortgage notes is to go start a business and advertise that you do hard money lending and go get licensed and go have people call you and set up a whole retail loan origination. And that's a lot of work, right? Our company, hassle-free Cashflow Investing. How do we remove that hassle of investing? Because the simpler a process is, the more likely the investor is to succeed. And so by making the process hassle-free, we do all the work. We go out to the marketplace and we work with those borrowers. We use our own capital to lend. And then once we make those loans, we then resell them to our clients once they're already originated. Oftentimes we'll go to mortgage note servicers, people who are servicing mortgage notes. And those mortgage note servicers have people that want to sell their notes because notes are very liquid, right? You were mentioning earlier liquidity, and equity in a property is liquid, but you have to sell the whole asset to get at it, and there's a high transaction cost with that. Mortgage notes are extremely liquid. You can get a buyer for your mortgage note in 2 to 4 weeks. You get your cash, and the transaction costs are relatively low compared to real estate. So you can definitely buy and sell mortgage notes, even though it might be a 10-year mortgage. You don't have to hold it all 10 years. You can sell it. So how to find them? Obviously, our company does specialize in helping investors buy mortgage paper. But if you were trying to do it on your own, banks sometimes sell paper, but you need a lot of money. There are, Craigslist, you might find the note, but that's a lot of hassle and good luck finding any notes of any particular quality. And note servicers, I think that's probably one of the better sources. Is if you can find a company that does service private mortgages and they're willing to work with you as a buyer, they might help you find notes. But oftentimes, they're going to refer you to a brokerage house like ours that has a lot more customer service skills and the ability to help investors identify their personal investment philosophy and identify what types of notes would be most suitable for their portfolio.
Yeah, that's a great answer. I'm really glad that you bring that up about the liquidity because it's great. We talk about turnkey real estate investing on our show an awful lot. And as wonderful as that is over the long term, if you need to get your money out in 30 days, maybe you can do it, but you probably cannot. So you're telling me if someone has a mortgage note and they're getting paid 10% interest on it, but suddenly they need a lump sum of cash in their life for some reason, they can go sell their 10% mortgage note. They can get rid of those payments that they're getting in small increments each month and sell it to somebody else and get their lump sum out in a short period of time.
That's absolutely correct. And that's the core of our brokerage business is there's investor A wants cash flow. Investor B wants to have a lump sum of cash. And so the person who wants the lump sum trades their money for income, and then the person who has income trades it for a lump sum. And then our company acts as the intermediary between those parties.
Okay. And I'm sure there's a number of it depends factors, but how quickly can one sell a note?
You can sell a note if you've got a very complete, thorough file that you can send over, you can sell a note in as little as 5 business days, but more commonly is 2 to 3 weeks.
That's pretty good. That's more liquid than real estate. It might take you 60 or 90 days, if you have an inspection finding and you're trying to sell a piece of real estate or something goes wrong with the appraisal. So yeah, I'm really glad that you brought up that angle. And listeners, the reason that I chose to bring David onto the show is it's not just because his company is called Hassle-Free Cashflow Investing. It's because David articulates his stuff really well, and he makes himself so available. I mean, if you need a company to have someone help hold your hand and get started with mortgage note investing, I don't know of a better one than Hassle-Free Cashflow Investing. Again, you can find that at hassle-free-cashflowinvesting.com. Because I truly want it to be hassle-free for you. I often talk about how my favorite investor metric is not cap rate. It's not cash-on-cash return. It's not even internal rate of return. It is what is your ROTI, what is your return on time invested. And when it's hassle-free, it helps enhance that.
And I love your motto, don't quit your daydream. And the real estate is a vehicle for producing the income that you want for your daydream. But for me, I started out investing in relatively lots of hassle investing. I started my own investor career as lots of hassle investing with no cash flow. And I realized really quick, well, that's not a good idea.
That's a really bad company name, too.
The marketing experts said that we should probably steer away from lots of cash flow. I mean, lots of hassle, no cash flow investing, right? So, for example, like houses. I made a lot of money buying houses for long term, but there's tenants and there's toilets and there's hassle and there's a lot of moving parts to owning a home, and they're relatively illiquid, and sometimes they produce cash flow and sometimes they take cash flow. And so I moved from houses into more commercial assets like net leased shopping centers and medical office buildings and bigger deals that were more stable and produce more income. But that was also a little bit of hassle too, because you've got tenants and toilets and parking lots, and your problems with shopping centers are just bigger. It's the same as houses. You've just got bigger problems to deal with. So for me, how do I get the most hassle-free return out there? And for me, mortgage note investing is the simplest, most passive, easiest, most risk-adjusted return that there is. And so literally at the first of the month, we hit the ACH button and the money shows up into our account. And that's it. I don't get a call from the tenant. I don't get a call from there is no tenant. The borrowers don't call, they pay. And if they don't pay, then we have a mortgage note servicer, which is someone who's like a property manager for a note. And that's actually hugely important, that I encourage people who are doing private lending not to manage their own mortgage notes, because private lending can be very complex, especially when the borrowers don't pay. And if you are working in that situation, you do want a professional to manage that note for you, to manage that borrower-lender relationship for you. One of the reasons I really love owning mortgage notes is it's simple to hire third-party management for those mortgage notes. So there are lots of mortgage note servicing companies out there that can handle all of the tax reporting, all of the calls to borrowers and issuing the letters to borrowers and handling the notice of default if the borrower doesn't pay as agreed. And the cost of that note management is extremely low. They do a whole bunch of services on your mortgage note for a very, very low cost. And many times, especially with the mortgage notes that our company sells to our investor clients, we bill the cost of the mortgage note servicing, we bill that to the borrower. So the borrower is paying not only principal, interest, taxes, and insurance, but they also pay note servicing fee on an ongoing basis. So the investor yield is a pure, 10%.
Okay, so unlike with turnkey real estate investing where the investor pays for that management, in this case, the borrower pays for it.
Yeah, it's a negotiable point when you write your loan documents, but if you can get the borrower to pay it, even better.
Yeah, that's great. David, I understand you have a free report that you put together so my listeners could learn more about this.
I do. So I've got a free white paper called Secrets of Hassle-Free Cashflow Lending, and you can download that report for free on my website at hasslefreecashflowinvesting.com. And also on our website, there are a number of free webinars, very extensive webinars on how to use your self-directed IRA to invest in mortgage notes. We've got a great call with a CPA who talks about the tax implications of mortgage note investing. And we've got a great call with several other mortgage note investors that are talking about the nuts and bolts and the mechanics of being a private lender. So there's a wealth of free educational information related to mortgage note investing on our site at hasslefreecashflowinvesting.com.
One more time, that's hasslefreecashflowinvesting.com. David Campbell, as always, it's been valuable talking to you. It's great that we finally had you on. Thanks so much for stopping by.
It was a great pleasure, and I congratulate all your listeners for tuning in to an awesome show.
Well, mortgage note investing is a great niche that is misunderstood and little known, and David is the type of person that makes himself so available to help you with this. He's been doing exactly that for people like you for 10 years. Go ahead and think about it this way. I suggest that everyone keeps some of their money in a liquidity bucket. But the problem with a liquidity bucket is that it usually means that your return on investment is like 1% or less in a checking account, in a money market fund, or a CD. So it's slowing you down. It's not moving you ahead. Well, now you just learned about a way to get a return of perhaps 10% or even more and have liquidity of just a few weeks' time. I mean, I love turnkey real estate investing, but it's not where you want to park your liquid dollars because the sale time on a turnkey real estate investment can take months, not weeks. Now, if you have other questions like, how do I ensure that I have good quality collateral in the form of that real estate that my borrower is paying interest on? Or just how do I structure this entire thing in a hassle-free way? Those are great conversation starters for David. So check out David at hasslefreecashflowinvesting.com for that free report called Hassle-Free Cashflow Lending. Or you can just schedule a phone call there with David at that website, which is free. And boy, what a great business name, Hassle-Free Cashflow Investing. I love that. Hey, coming up soon, you're going to hear from Get Rich Education's right-hand man, John Collins, for the first time on a future show as I bring him in here for a few minutes. You've heard me mention John on the show every few episodes. John is GRE's business developer. I call him my right-hand man here, but more importantly, when you consider that you are the average of the 5 people that you spend the most time with, you'll see why I'm proud to consider John my best friend. In fact, John is the one that introduced me to David Campbell a few years ago. Hey, well, special thanks today to the talented David Campbell. If you liked our discussion and you want to continue it with David, one more time, check him out at hasslefreecashflowinvesting.com. Next week, we're going to talk about something that you probably care about as a Get Rich Education listener, and that subject is your money and actionable ways to increase your personal cash flow with very little effort. Until then, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.